Hello, everyone. Thank you for joining us for our session, How Evolving Technology Shapes Stakeholders' Roles and Methods, presented by Kim Mendoza, Assistant Professor at University of Illinois, Urbana-Champaign. My name is Alexander. I'm part of the higher education team here at Exec, and I'll be helping to moderate today's session. Before we begin, I have a few brief housekeeping items for our audience. First, all attendees are in listen-only mode. However, we encourage you to engage in the session by asking questions, which you can do using the question box in your GoToWebinar control panel. Please make sure to use this feature for all the questions, as well as any feedback or comments you may have for the presenter. We'll be having a formal Q&A session, so please feel free to send in your questions throughout the session. Additionally, as you may know, we're recording today's session, so you can look forward to receiving a copy of the recording via email in the coming days. And now it is my great pleasure to introduce to you Kate Deering, Assistant Director, Recruitment and Admissions, GIS Graduate Programs Online, University of Illinois, Urbana-Champaign. Kate?
Thanks, Alexander. Welcome everyone to our Ivy Exec webinar today. We're really excited that you're here today. As Alexander said, my name is Kate Deering. I work in the recruitment space in GIS College of Business in the online program space with our graduate students. So thanks for being here. It's a pleasure to have everyone here joining us for the next hour, where we're going to learn about the impact of innovative technologies on stakeholders that are involved in financial reporting. So I hope you're excited. At GIS Business, we offer graduate level online credentials. So I wanted to just give you a little bit of a background about GIS. These credentials are designed to propel your career forward, regardless of where you are in your learner journey. So our portfolio includes 3 online master's degree programs: the Master of Business Administration, Master of Accountancy, and Master of Science in Management, along with 13 graduate certificates. So these certificates actually combine 12 credit hours of transcript credit that is stackable into our master's degree program. So these cover topics like strategic leadership and management, accounting data analytics, maybe you like entrepreneurship and strategic innovation, and many other topics. Our graduate programs at GIS are not only innovative, but they're also really affordable, and they're tailored for online learning to really provide flexibility without compromising the interaction and the collaboration that you would have within the classroom space. You'll have the opportunity to learn also from global peers with very diverse professional backgrounds. During today's session, you're going to gain some valuable insights from one of our esteemed instructors, just offering a little bit of a glimpse into the cutting edge content and research that's happening within GIS. Our graduate courses blend a foundational material that's available on the Coursera platform with a robust interactive component from the University of Illinois. This includes live weekly classes, group projects, faculty office hours, networking opportunities, and really just the unique experience of being part of the University of Illinois. If you're interested in learning more, feel free to reach out to us at gisonline@illinois.edu. But what we're all here for today, I'm very excited to introduce our speaker, Kim Mendoza. Kim is an assistant professor at the University of Illinois at Urbana-Champaign. She is a Grant Thornton faculty fellow and the director of the Deloitte Foundation Center for Business Analytics. Kim earned a BS in accounting from Loyola Marymount and an MS and PhD in accounting from the University of Washington. Joining GIS back in 2017, she does teach several data analytics courses, which cover concepts from data visualization to machine learning to automation. She has also developed a course that was awarded the American Accounting Association's 2021 Innovation in Accounting Education Award. And in addition to teaching, her research really focuses on the intersection of accounting, technology, and psychology. So very, very interesting. Please join me in welcoming Kim Mendoza.
Well, thanks, Kate. I'm really excited to be here to talk about how evolving technology shapes these stakeholders in the financial reporting process. So as Kate mentioned, my teaching is around data analytics and business analytics. I teach both I've taught in the undergrad, the master's, and also in the online programs, and I teach data analytics courses. In addition to my teaching, my research, which I'll talk about today, also revolves around technology and its impact on stakeholders in the financial reporting process. So first, I want to talk high level about the financial reporting process. So financial reporting is the process of taking financial information, so transactions that have happened to a company, events that have happened over the course of a year, and compiling that information into a set of financial statements. And that information is compiled according to a set of rules. So these rules depend on your locale. So if you were in the United States, the rules would be the US Generally Accepted Accounting Principles, or GAAP. If many other countries outside of the US use IFRS, International Financial Reporting Standards. But essentially, all those rules are meant to create financial statements that are understood by external stakeholders and can be comparable across companies and industries. So that's financial reporting at a high level. So when we think about incorporating technology into the financial reporting process, most people are thinking mostly about how is this technology going to impact the process? And usually it's about improvements to many things. So it could improve efficiency of the process. Perhaps before the technology is implemented, a person is pulling reports from all different information, all different resources or systems to compile the financial information. So technology can improve efficiency because now you can write a bot that can do this and pull all of this information. So instead of a person doing it over the course of an hour or a few days, it now takes minutes. Another way that we think about technology impacting the process of financial reporting is by improving effectiveness. So effectiveness is how well is this process performed. If you think about what technology does, it's program, computer code that's written to follow a set of rules. And so the computer is never going to deviate from those rules. So it's always going to perform these steps in the process exactly as written. So if the code is written well, then it will not have errors, or at least the errors won't be unexpected, or errors that are deviating from the rules that we've outlined. Whereas a person who might be performing something in this process, if I was typing in a journal entry or a transaction, maybe I'm really tired that day and I flip two numbers as I'm typing in information. So those sorts of errors, technology isn't going to perform, which is one way that technology is improving the effectiveness of the financial reporting process. A third way that technology is impacting the process of financial reporting is helping our understanding. And so it's understanding at a broad level as well as a very detailed level. So now that we have, or we're using these business analytics, data analytics, machine learning, artificial intelligence, we're able to analyze large sets of data to gain a broad understanding of the company, of an industry, comparing companies to one another. That helps us improve our understanding. Also, with these tools, we can gain a more detailed understanding because we're able to dig deeper into the data with the new technological tools that we have. So when we think about technology and financial reporting, a lot of people think about it with respect to the process. However, there are also many people involved in the financial reporting process. These people are subject to biases. And so sometimes when we think about incorporating technology into financial reporting, we don't always think about how it's going to impact what people think, what people do in their role in this process. So people come into the process at all different stages. People are involved in the process of compiling the financial information. So we think about people internal to the company. People are also involved in making sure that the financial information or financial statements are prepared according to a set of rules. So people will check to make sure that the financial information is properly stated, and these are our auditors. And then people are also involved because they are the external stakeholders. We have people who get the financial statements, get the financial information, and then make some kind of decision using this financial information. So while this process, technology is being brought in to help improve the process, it's possible that bringing in this technology can impact many of these people in unexpected ways. And so some important people in the process are managers. So those are the people compiling the information. They're internal to the company. Auditors are the people who check the financial information to make sure that it's prepared in according with whatever rules they need to be prepared according to. We also have investors. Those are one group. That is one group of external stakeholders who take this, take the financial information or financial statements and decide whether to invest in the company, to buy more shares of the company, or to give money directly to the company. A second external stakeholder would be lenders. Lenders also want to get this financial information to make a decision on whether or not they should lend the company money, or if they do lend the company money, what interest rate makes sense for that company. And so this financial reporting provides them information to make that decision. So where my research comes in is with these people. So I look at technology and its impact on the people in the process. So specifically, I focus on how investors are impacted by technology, how managers within a company are impacted by technology, and then how auditors are also impacted by technology use. So again, looking at the people and how they respond in perhaps unexpected ways. I do a lot of research on this, but I'm only going to cover 2 examples today. The first is how investors respond to robo-advisors, and I'll talk a little bit more about what those are. And then also looking at managers and auditors and their interactions, so how managers respond when their auditors are using technology on the audit. So I'll start today by looking at this first one. So this first research project is about robo-advisors, and what motivated this research investigation was this question of, would you trust a robo-advisor's advice on which stock to purchase over, say, a human advisor's advice? If it's the same exact advice and you're getting it from a computer algorithm who comes up with this advice based on some computer code, would you trust that to the same amount as a person who comes up with the same advice? So when this project came about, there was a lot of press about robo-advisors. There's this cartoon about where you see a robot showing a stock chart and a person handing over their money. We saw articles on the advantages and disadvantages of robo-advisors, how robo-advisors were increasing. But what a robo-advisor is just a computer program that takes in financial information that has been either put out by the company or is out in the world, and it makes some sort of decision or recommendation based on that, some computer algorithm and mathematical equation of some type. And while all of these pictures here show a physical robot, so we see a robot with a face and arms and eyes, it's really not actually a physical robot, it's just a computer algorithm, it's code. So we were interested in these robo-advisors that were growing in popularity. What we also saw outside of the robo-advising domain was that a lot of companies try to humanize the technology to make it more accessible, to make people want to use the technology more, to make it easier to use. And so while we saw those pictures, the way that companies humanize some of this technology is sometimes it's a little creepy, where we do see people putting facial expressions and eyes and arms on this technology. But in reality, with in the domain of financial reporting, it's probably more helpful, or in other domains. So if we think about Alexa or Siri, this is adding a name to technology. So a name is a way of humanizing technology that allows individuals to interact with that technology or make them want to use it more. So Siri and Alexa are really helpful because I can ask Alexa what the weather is for today or what the weather is going to be this weekend. I can ask Alexa to play music for me. So it's helpful because then I don't have to go through the process of looking up a song on my phone and then playing it. So humanizing technology can be helpful. And so we wanted to investigate whether this was happening in the financial reporting and advising domain. And we saw that Bank of America started to, at this time, back in the 2015 timeframe, Bank of America was releasing Erica, which now if you have the Bank of America app, you can chat with Erica on your phone. But Erica was a financial assistant who can help you do mobile banking and answer other questions you have with your banking. So we saw that humanization was happening or beginning to happen in the financial domain. We also saw at the time that Wells Fargo was coming up with a robo-advisor and was talking about naming this advisor. So this trend in humanization, or at least naming of technology and the use of robo-advisors led to our overall question, which was, would you trust a robo-advisor's advice on which stock to purchase over a human advisor's advice, which I showed earlier? And how does naming impact that reliance? So how did we investigate this question? Well, my research, I research people, and what my research does is I use experiments to put people in a hypothetical scenario and ask them to imagine they're in this scenario and then answer questions based on what they think they would do in that situation. So this is where I draw on psychology to do my research, but in a business setting in a financial reporting domain. So we use an experiment, and our experiment, essentially, I ask investors, a couple hundred investors, and I split them into 4 groups. And each of those 4 groups reads a different sentence about their financial advisor. So they will randomly see one of 4 descriptions of their advisor. So no individual sees all of these descriptions. Each individual sees one of them, depending on which of the 4 groups they've been placed in. So the first group sees your financial advisor is a computer algorithm from HMS Investments. So this is the group that sees that they're using a robo-advisor, and the robo-advisor does not have a name. The second group sees your financial advisor as a person from HMS Investments, and so this is a hypothetical investment advisor, investment firm, and this is where people think that their advice is coming from a human. The third group is where we add in some humanization. So we say your financial advisor is Charles, a computer algorithm from HMS Investments. So again, they think they're using a robo-advisor, or we're having them imagine that they're using a robo-advisor, but that robo-advisor's name is Charles in this case. And then the last group, you can probably guess, your financial advisor is Charles, a person from HMS Investments. So again, they are imagining that they're getting this information from a human, a person, and that person's name we provided as Charles. So after all these 4 groups see a different sentence, now everyone sees the same information. So it's the same financial information for 3 different hypothetical companies. So we created some fact sheets that provide information about the companies, and this is just high-level look at all the information that they're seeing. We're not going to go into detail about what they're seeing, but they see some financial information you'd see on the financial statements, information about the industry and the economy, what they predict the outlook for the firm will be, and all the numbers are slightly different, but the trends are pretty similar. And what's important here is that of these 3 companies, their advisor recommends investing in only one of them. So in AGQ, this hypothetical company, we say that your financial advisor's recommendation at the bottom is that this is undervalued and they recommend investing in the company. So this is the advice, and this advice is the same for all people, all investors who were taking the study and imagining the scenario. But the 4 different groups were imagining that this advice was from either a robo-advisor or a human, and their advisor may or may not be named. So the 4 different groups were thinking it's from a different advisor. So after viewing this financial information, reading through it, seeing what their advisor recommends, we then ask everyone the same question. We say, how likely are you to follow your financial advisor's recommendation? So this is just a simple scale that they answer, and they answer this question. But if you put yourself in this experiment, in this situation, if the financial advice is truly exactly the same, the financial information is exactly the same, do you think you would answer this question differently if your advisor was a robo-advisor or a human? This is really a thought experiment. And would name matter? Well, rationally, if all of the information is the same, the financial information and the advice is the same, and there's truly no difference in the advice, whether or not it's coming from a human or a computer algorithm, or whether or not a name is provided, should not matter in how reliable this advice is, how much you trust, or how much you'll use this advice in your decision making. But we find that it actually does matter if the advisor is a human versus if it's a robot or a computer algorithm, and it matters whether a name is simply provided. So what we find, if we'll talk about all the 4 groups compared to each other. So the 2 groups who thought the advice was from a person, one group, we told them the name was Charles, the other group, we didn't say a name. We find that if they're weighting the advice, that if it is provided by a human, people are more likely to weight the advice if it comes from a person that provided their name. And we speculate this is because if you provide a name, you're putting your reputation on the line. You are essentially saying, I'm giving this advice, and you're tying it directly to yourself. The advisor is, and so people trust this advice more. If we look at the robot setting or the computer algorithm setting, we find the opposite effect. So we find that people weight the advice or are willing to follow the advice more if the computer algorithm does not have a name. And so we speculate that this is because financial advising and picking stocks for many people is a pretty complicated task that we don't do day to day. When we ask Siri or Alexa to look up the weather or play music, this is something that we can easily do. We can imagine ourselves doing that. And so providing a name maybe helps there. But in a very complicated domain like financial advising and choosing stock recommendations, we think of it as complex. And a computer algorithm we think of that as complex too. So that kind of matches or fits. So individuals seem to like that the computer algorithm is complex and is performing this complex task. But when we add a name to it, it essentially makes that computer algorithm feel more accessible and simple. And we individuals or investors who took this study rely less on that information. Now comparing across the robo-advisor and the human, which is really an interesting piece that we were investigating because of the change or shift or increase in robo-advisors and their use. We saw that when no name is provided, people rely more on the robo-advisor than the human. And so they trust the robo-advisor more than they trust a human. But then when a name is provided, they trust the human more than the robo-advisor. So we saw some really interesting effects here that while it shouldn't matter if the financial information and advice is truly exactly the same, whether or not it comes from an algorithm or a human, or the human or algorithm has a name or not, should not have a significant difference in our investment decision, but it seems to in a lot of different ways. So what do we do next? What we found was actually in conflict with what a lot of prior research thought about naming technology. When prior research at the time was investigating naming technology like Alexa and Siri, it found that people were more likely to rely on it, that it was good. It increased accessibility and use of that technology if you did name it or humanize it. But what we found was in conflict, and so we investigated what we thought could be the case is that it depends on the complexity of the task. Like I said, Siri and Alexa do pretty simple tasks that we could also perform, whereas a complex task like choosing the right stock, maybe not everyone could do or feel like they could do. So we investigate complexity, and so we describe an investing task that a computer algorithm is doing, and we find that when the task is described as relatively simple, people rely on the named robo-advisor more than an unnamed robo-advisor. So this is what prior research in naming technology had found. So that people rely on the technology, they find it more accessible, more useful when it has a name. So that's what we found, but only when do we describe the task as a relatively simple task. If we instead describe the task as relatively complex, so we say the task that your robo-advisor is doing is complicated, we find the opposite effect. The effect is consistent with the results of our first study. We find that people weight the advice of the robo-advisor more when it does not have a name. And so the weighting of the advice or the reliance on technology that's named or unnamed really comes down to the complexity of the task. So if we think this is something that's simple that we could probably do, we like when it's named, it makes it more accessible, the technology. But if it's something we don't think we can do that's complex, we want the technology to also be seen as complex and to seem like that's something that we also couldn't do. We couldn't program this computer algorithm to complete the task. So to wrap up this example, our findings were providing some insight on technology and its impact on investors. So one stakeholder in the financial reporting process. We added to what we knew about naming technology by finding that task complexity is really a key piece to how people are going to respond to technology when it's named. So this is my first example of one research project that investigates how stakeholders in financial reporting are impacted by technology. And this is just one area. Research is very broad in how technology, in its investigation of technology use on stakeholders. And so this is just one example of a new technology that was coming in to the investors domain and how it impacted the person, the people, the investors, and their own reliance. So robo-advising probably did improve some efficiency, effectiveness, understanding, all of those things in the process, but it has these unintended consequences of also impacting the investors themselves and their trust and reliance on the financial advice. So the second example is looking at these other two stakeholders, so managers and auditors. And so we investigate managers' response to auditor technology use. And again, this is one of many research projects that are out there, but I think it's a really interesting to look at the dynamic and interaction between these two stakeholders. So the setting we're looking at is the audit setting, and many of you may be familiar with this, but audits, for those of you who are not, audits help improve financial reporting quality. As I mentioned in the very first few minutes of the presentation, auditors are checking to make sure that the financial statements are prepared in accordance with whatever rules are necessary for the location or the locale. So in the US, this is GAAP, or generally accepted accounting principles. While audits do improve financial reporting quality because auditors will check to make sure they'll find errors, they might find fraud, they'll often uncover different things that help improve financial reporting quality. Fraud continues to exist. So if we see these three pretty prominent audit accounting firms that have an audit division, these are some examples of more recent fraudulent reporting or aggressive reporting things that have happened. And so even though these companies were audited, aggressive and fraudulent reporting can still happen. And for many reasons, this could happen. So what motivated our research is what sort of things impact a manager's decision to report aggressively in their financial statements. So if there's a gray area, what about this interaction between the auditor and the manager can cause the company to report more aggressively or less aggressively. So this is what was motivating our research. And so we were looking at two specific characteristics or attributes of the auditor that might impact how managers decide to report financial information. So the first characteristic that we look at is auditor independence. So auditor independence is, if you think about the financial reporting process, a company creates their financial statements and then an auditor checks the financial statements. So independence means that we want those two groups to be independent and to not have any conflict of interest, because if the auditor is checking the financial information, we want the auditor to be free from any biases that they might have, so that if they find an error, they're going to actually disclose the error or make the company change that error. So independence is very important in the auditor domain, but there are variations. There's a spectrum of independence. So some auditors are more independent, while some auditors may be less independent. So a more independent auditor is also more objective when checking the financial information of a company. So this picture just shows the client managers are separate from the auditors. So the auditors are in their audit room, checking, double checking the financial statements, checking the processes to make sure that everything is working as it should be, and that the financial information is following the set of rules that it should follow, and that it is free from material errors. The client managers are separate. So they are the ones that are preparing this information, preparing the financial statement that will eventually be checked. So the independent auditor is hired by the company. They're external to the company. While the client managers and the auditors are truly from different companies, sometimes the auditors have been a part of the company or have been auditing the company for many years. I was an auditor for the first part of my career. There are situations where you're an auditor at a company and then a few years later, maybe you get hired at that company when you leave the audit firm. And so this can create some situations where perhaps there's less independent or less objective auditors. So the client managers and the auditors may be friends because they see each other every quarter, every year. Maybe the client used to be an auditor at that accounting firm. And so when there are these more personal relationships or social relationships, independence and objectivity may be viewed as slightly different because of the relationships that have maybe built over time. So this is one thing that might impact the aggressive reporting of a company. If, say, you're really good friends with your auditor and you have the opportunity to maybe make an aggressive estimate, aggressive reporting, a company might be more likely to take that chance, that opportunity, because they think their auditor will let it slide, perhaps. Whereas if your auditor is truly independent, you don't have that friendly relationship, then you may be less likely, or a client, a manager, a company might be less likely to make aggressive reporting decisions. So a second feature that we were curious about, whether it would impact aggressive reporting for managers, is technology, because my research does focus on technology and investigates the impact of technology. And technology, because as I mentioned with the first example, is just computer code. It's code that has been written, and the computer cannot deviate from this code. It just follows the code that has been laid out. It's viewed generally as more objective. It's at least perceived as more objective and less subject to biases. Now, this may or may not be true, because there's a person who programs the computer algorithm who may also be subject to biases. But if people were to judge their expectation of whether or not an algorithm was biased, people tend to believe that it is more objective than a human who is subject to biases. They can be friends with someone, and so they can be nicer to that person. So we thought that we're investigating whether using these innovative technologies instead of the more traditional approach of having people do most of the audit, whether using these technologies makes the companies think, or the managers within the companies think, the auditors may be more objective because they're using these objective technologies. So we investigate these two characteristics that we thought could impact how managers view their auditor, and that would impact their aggressive reporting. So our research question became, when we honed in on a research question, was how does the level of independence in the auditor-client relationship and the use of innovative technologies by the auditor, such as data analytics and artificial intelligence, how does this impact client managers' aggressive reporting? So because I run experiments, I have people imagine themselves in a scenario and answer questions based on this scenario. We had people who our participants in the study were people who truly were involved at their companies in the financial reporting process. So they actually help prepare financial statements. So we use people who most of them have experience interacting with auditors. 70 to 80% of the people who took this study have interacted with their auditor, but all of them have some involvement in the financial reporting process and creating financial statements. So we had those types of people take this study. We have them imagine they're a controller, and we tell them that their company's goal for people to reach their bonuses for themselves and their colleagues is to reach 400 million in profits. And so this is the company goal that they're imagining their company has. We again split our participants into 4 different groups. So half of them have a more independent auditor and half have a less independent auditor. And so we just changed a few words in our description of their auditor. So in all cases, they have a good professional relationship with their auditor, which we named AJR, so a hypothetical auditor. But then the more independent group, they don't have a personal relationship. They do not meet up with their auditor socially outside of work. So they have this distance between themselves and their auditor. Even though they have a good professional relationship, there's no social relationship. In the less independent group, we say that, again, they have a good professional relationship, but they also have a personal relationship where they meet outside of work for social activities. So it's really just, they are friendly with their auditor and they spend time with them socially. So this is when an auditor is less independent. There could be a situation where the auditor might have some biases, and so this is what we want to investigate. We also have the presence of technology, artificial intelligence, and data analytics. For half of our group, we say that their auditor uses these cutting-edge technologies to conduct the audit. So we say they use artificial intelligence and data analytics tools. For the other half of the people taking this experiment, we say their auditor uses traditional audit methodologies. So they perform their audit testing manually, and the engagement team, so the people on the team, perform the audit. So we now have these 4 groups where we have people who are not social with their auditor, but the auditor uses technology. People who are not social with the auditor, but their auditor uses manual audit testing. Then we have people who are social with their auditor, who their auditor uses technology, and people who are social, but their auditor still does the manual audit. So we have these 4 groups again, and we compare these groups specifically, or before we compare them, what I tell participants is that their company's profits are $397 million, so just shy of their $400 million goal. But in the financial reporting process, there's a lot of estimates that are made. And so they learned that there is an accounting estimate that has a range, the warranty reserve liability, that can be adjusted. So we say that the best estimate is 63 million, and that's how they got to their total profit of 397 million, and that their calculations suggest that it will definitely, almost certainly fall between 61 and 65 million, but they could adjust it just outside the range. So they could aggressively report this warranty reserve liability in order to meet their profit goal of 400 million. So there's some incentive there for them to adjust it, because they can imagine, this is hypothetical, that they'll receive some bonuses, their colleagues will receive bonuses, but it is aggressive reporting because it's outside the reasonable range of estimates. So participants then make a decision. We say, as the controller of this company, this hypothetical company that we call JMS, how likely would you be to adjust the warranty reserve liability? So to adjust it from the best estimate to an aggressive estimate of 60 million. And people answer this question, and again, we have the 4 groups, and it turns out that the independence of the auditor and whether the auditor uses these new technologies impacts how aggressively the company or the participant is likely to aggressively report. So specifically, when we look at when the auditor is more objective, so this is when the auditors are in their audit room and they don't spend any time socially with the managers, so the client managers and the auditors are separate. This is more independent, so we might expect the auditors to be viewed as more objective. We find that whether or not technology is used, so if that auditor uses technology or if the auditor does not use technology and is very manual in the process, we find that the degree of aggressive reporting is similar. So the client or the participants, when they imagine if they would be likely to adjust the estimate, there's no difference. As long as the auditor is independent, it doesn't matter whether or not the auditor uses these technologies that are viewed as objective, or whether the auditor uses manual technology or manual processes. So it's just the people that are doing the audit. So if the auditor is already objective, there really isn't any need for a boost in objectivity coming from technology. However, it gets really interesting when the auditor is less independent. So when independent decreases, where the client manager and the auditor have known each other for many years, they maybe hang out socially occasionally outside of work, we find that there is a difference if the auditor uses these innovative technologies versus if they use more of a manual audit process. Specifically, if there's a more manual audit process and it's just these people, the auditors, performing the audit, then our participants were more likely to report aggressively, to take advantage of this warranty estimate, because it is an estimate, and move it just outside the range of reasonable numbers, reasonable values. So we found that there was more aggressive reporting if the auditor is less independent. So there's an expectation that maybe they would be more lenient on the client. And so it was interesting to see that they would report more aggressively. So independence truly is a very important feature that's needed for audits. But if we just have the auditor still be the same auditor, they still spend time socially with their auditor, but they use innovative technologies, these technologies that sort of are viewed as more objective, that brought that aggressive reporting back down to the levels of an independent auditor. So simply by having these new technologies, artificial intelligence and data analytics tools in the audit, even if the auditor is not objective or is less independent, the manager isn't going to report aggressively or take advantage of a gray area or an estimate, a scenario when there's not a precise number. So there's wiggle room in the estimate. So what we see is that technology can help mitigate some issues related to independence and objectivity. And the reason we see this is because we also measured participants' views about their auditor's independence or whether there was a threat to independence in this situation. And they only really viewed a threat to independence when the auditor had the social relationship and did not use technologies. Once technology was used, participants did not view any threat to independence in this situation. So this is another example of how technology is impacting the people. So the scenario is pretty similar. The manager is making the same decision, but whether or not technology is used by some outside group, their auditor, is impacting the internal decisions of the company. It's impacting the financial reporting and what information is ultimately going to be viewed by the external stakeholders. So some high-level takeaways of my research is, well, first, these are just 2 studies of many on the impact of technology and financial reporting. And so there's a lot of research out there since the advent of technology and since it's really increasing in recent years of how this technology impacts the people. And there's a lot of research on how it impacts the process as well. And these are just 2 examples, one of how investors are impacted and one how managers are impacted based on their auditors' technology use. So the takeaway is that technology doesn't just impact the process of financial reporting by improving efficiency, effectiveness, and understanding, but it also affects the people involved in financial reporting in unexpected ways, because people are subject to biases and they're subject to making quick snap judgments. And so these people, it's important to understand how people are impacted by technology in these surprising ways. So that is all I have for you today. I'm happy to answer some questions. I know we have some time for Q&A, but hopefully you gained a little bit more knowledge on the financial reporting process and how some technologies, some newer technologies, are impacting the people involved.
Well, first of all, thank you so much, Professor Mendoza. It was we truly appreciate the opportunity to have you present for the Exec audience. Thank you so much for the very informative presentation. We did receive a couple of questions, and I'll just jump right to them. The first one says, in your opinion, what are the most pressing challenges that stakeholders face in adapting to and leveraging innovative technologies for reporting purposes?
What are the challenges that stakeholders, can you repeat the last part of the question?
Sure. What are the most pressing challenges that stakeholders face in adapting to and leveraging innovative technologies for reporting purposes?
I think that a lot of these innovative technologies do have huge benefits to companies, but probably one of the biggest challenges is also is the implementation and the acceptance of people changing their ways. At least what I've seen is that when a process isn't broken, we don't want to fix it. But if a process isn't broken, it can still be improved. And so these technologies can improve that process. And sometimes people are sort of they're sort of against changing the process and changing the ways things have been done. So I see that as one of the bigger challenges to implementing some of these technologies. I think another challenge is the challenge of choice. There are so many technologies out there, and many of these technologies can do the exact same thing. They just have varying levels of maybe ease of use and cost. So if you think about a programming language like Python, that language can do so many things, but you have, say, a technology like in automation like UiPath, that's user-friendly. You don't have to know programming code in order to automate tasks using that technology. Whereas you could do the same exact thing in Python for lower cost, but it's a lot more effort to do. So I think the choice of which technologies to use can also be a challenge. And then the learning, there's a steep learning curve with a lot of these technologies. And I think that is probably the third challenge, I would say, because these technologies are coming out, and often it's like our fresh graduates, our younger people that are just starting at a company who have a lot of familiarity with these tools. Whereas in the past, there was, I think, when I think about my time as an auditor, there was knowledge that you gain over the many years you are an auditor. So when you're a partner, you're the expert. But now these people are coming in, these fresh new hires are coming in with more knowledge on these newer tools than people who've been around for a long time. So there's kind of this shift in knowledge. And so putting in the effort to gain that knowledge, I think, is a third challenge that I see in the implementation of these new technologies.
Thank you very much. Okay, the next question. As technology continues to evolve rapidly, how do you anticipate the regulatory landscape adapting to ensure the integrity and reliability of financial reporting processes?
That is a tough one. I think that regulation in the financial reporting setting is sometimes like trying to be proactive, but sometimes ends up having to be reactive. So something has to happen that then needs to be fixed, or something comes about that we now need to figure out how to work with it. Because in financial reporting, we're not the experts in what technology is coming next, but I think there are a lot of challenges because we don't know what we don't know. We don't know what technologies are going to come out, what processes are going to be improved. And so I think the best thing that we can do is just to stay alert and to work quickly because it's constantly changing. I don't think there's one cure-all or one fix or one way to improve the challenges that will come about, because they'll constantly be new. So I think just staying on top of it is probably the best thing that can be done, not just by regulators, but by companies, by audit firms. And I know that I have auditing experience, so I know that the audit firms are really trying to be proactive about these new technologies. And so I think that's a great way to go about it.
Thank you. And we have time for two more questions. The first one says, what strategies do you recommend for organizations to effectively navigate and mitigate the impact of behavioral biases in their utilization of technology for financial reporting?
That's a good question. So there are people who are researching this, and there's always the easiest way to mitigate biases in any field, not just in financial reporting and technology, but any bias is training. So you want to make sure people know about these biases, and biases often happen when people make quick decisions or don't think about all of the pieces. And so being sort of deliberate and taking time in decision making, which I think these technologies, they work so quickly that we sometimes feel we also have to act quickly, but I think they also free up time. And so thinking more deliberately about how we use these technologies, not just when we implement, but while we're using them, thinking about just thinking deliberately, because this activates our more critical thinking versus our fast, maybe biased approach to thinking. Another way that I've seen is involving humans in the process. So it's called human in the loop, where you have this algorithm, but somehow involving people in that process, whether it be at the end of the process, reviewing the information before it goes to stakeholders. If people think there's a person involved in the process, then we see some of these biases go away. But there's a lot of different ways that biases can be mitigated, but I think knowledge and training and taking time to think through, taking time to think through how you're using these tools and the outputs of these technologies will help to mitigate many of these biases.
Thank you. And the last question says, how do you foresee the balance between human judgment and technological automation evolving within financial reporting processes in the coming years?
That's a very interesting question. So currently, I would say technology can't really do what humans can do when it comes to judgment. So that's really where we still need people in the process to make these judgment calls, because judgment calls come about when we don't necessarily have a pre-programmed set of rules to follow. So I think there will often be judgment calls that need to be made, and that technology will not be able to, at least for the foreseeable future, will not be able to make most of these judgment calls. But as we see this data, big data, and all these judgment calls happening, if we're able to evaluate these judgment calls on a broader basis, I think that technology may eventually be able to help with facilitating some of these judgment calls. Because if you make a judgment call on a one-off event, it's hard. But if there's 1,000 companies making the same judgment call, and we now have that data, we can improve that judgment using technology, and maybe at some point in the future, the technology could kind of help make that judgment call. But as it stands now, I think there will almost always, for the foreseeable future, be judgment calls that humans will have to make. And I think technology comes into play when we can get the data on enough judgment calls to have a better set of rules.
Well, once again, thank you so much, Professor Mendoza, for sharing your knowledge and your research. We truly appreciate the opportunity to have you present for the Exec trial. And I would also like to thank you all for joining us today, for sharing your thoughts and your questions. As mentioned at the beginning, we have recorded this webinar, and we will make sure to share the copy of the recording in the coming days, so you can look for those in your inbox. And I just want to leave you with a great rest of the day, and take care, everybody.
Thank you.